$440 million, gone in 45 minutes. And the company that lost it didn't get hacked, it did this to itself, with one file, left on one machine. On the morning of the 1st of August 2012, Knight Capital was one of the largest trading firms on Wall Street, handling roughly 1 out of every 10 shares. Traded in the United States. By lunchtime, it was effectively finished. You'd assume a loss this size takes a market crash, or a rogue trader making a reckless bet. It took something far smaller, an old piece of code that was supposed to have been deleted 9 years earlier. This is exactly how one dormant file destroyed a Wall Street giant in under an hour, simply explained. Start with what Knight Capital actually did. Their system, called SMARS, was an automated order router. It took incoming stock trades and split them into smaller pieces, sending them to different exchanges at high speed. It ran across 8 servers working in parallel, each one supposed to run identical software. That week, Knight needed to update the system for a new NYSE program. An engineer manually installed the new code onto the servers, one at a time. 7 of them received it correctly, the 8th did not. Here's why that one server mattered so much. Years earlier, back in 2003, Knight had used a test feature inside SMARS called PowerPeg. It was designed to buy and sell stock automatically, over and over, as a way to test other trading systems internally. Knight retired PowerPeg years before 2012. They stopped using it, they warned staff not to touch it. But nobody physically deleted the code from the servers, it just sat there, switched off, gathering dust inside a system nobody thought to clean out. Then came the update. The new program reused an old configuration flag, a small setting inside the code, without realizing that same flag used to be PowerPeg's on switch. On 7 servers, the new code simply ignored it. On the 8th, the one that never got updated, that flag woke PowerPeg back up. At 9:30 that morning, the market opened, and that one server started doing exactly what it was built to do 9 years earlier, buying and selling stock. Automatically, again and again, as fast as it possibly could, except this time, with no supervision, no limits, and real money. And here's the part that turned a bug into a catastrophe. Knight had no kill switch. There was no system watching for this server as behaving nothing like the other 7, and no automatic brake to pull. So for the next 45 minutes, that single machine fired off order after order into the market, completely unchecked. By the time human beings noticed something was deeply wrong, the damage was almost impossible to grasp. In 45 minutes, that one server had sent out roughly 4 million individual orders. It had bought and sold across 154 different stocks. And it had built up about $7 billion in stock positions that Knight Capital never intended to hold bought. High, and often immediately worth less. When the firm finally shut it down and added up what those unwanted positions had actually cost them, the number was $440 million. To put that in perspective, that loss was larger than Knight Capital's entire market value the day before. In under an hour, one server had lost more money than the whole company was worth. Wall Street noticed instantly. Over the next 2 trading days, Knight's own stock price collapsed by roughly 75%. As investors realized the firm might not survive the week, to keep the lights on, Knight had to accept an emergency $400 million rescue investment within days, a deal that handed effective control of the company to the very investors who bailed it out. The next year, regulators weighed in. The Securities and Exchange Commission fined Knight Capital $12 million, ruling that the firm had violated basic safeguards required for any company allowed to send automated orders directly into the market. Within months of the crash, Knight Capital, a firm with a 17-year history, no longer existed as an independent company. It was folded into a competitor, becoming what's known today as KCG Holdings, and years later, that combined firm was absorbed again into Virtu Financial. So here's the uncomfortable lesson this leaves behind. Knight didn't get breached by a hacker, and nobody made one single catastrophic decision that morning. The failure was quieter than that old code nobody deleted, a deployment that quietly missed one machine, and no safety switch built to catch the difference. 3 small gaps, each one forgettable on its own. Together, they erased one of Wall Street's biggest trading firms in less time than it takes to eat lunch. And if you think a story like this belongs only to Wall Street, it doesn't. The same pattern, old code left running somewhere it shouldn't be, one system quietly different from the rest, has taken down airlines, hospitals, and half the internet. That exact story, at a very different kind of company, is the video on your screen right now.